weekend. It takes 2 days to get through that self-paced course. You must go through the FAQ, watch those videos. A lot of you do not do that. I can tell by your questions that you email in. A lot of times you email questions that are right in the course. You know, I don't mind answering questions, but it's, you know, I try to send people to do some of your own work, because then it really sticks. Then you own it. And it's very important that you own your tools. These are your tools for your trade. And if you don't own them, you will never be able to master them. Okay? So you must understand them fully, and knowledge is power. So with that, before we get into all the nitty-gritties, we're going to go over some of the basic rules. Yeah, let me know if the sound goes in and out. Having some issues a little bit tonight. Apologize. We should get this sorted real soon. I am abroad, so I'm a little challenged in some nights. Also, I'm broadcasting, you know, 2 o'clock in the morning my time, and sometimes the internet companies reboot because they think people are sleeping at that time. So if I, for any reason, get cut off, don't disappear. I will always reconnect. I'll do my very best to reconnect, and so stay in the room, and I will restart the room for any reason. Okay? If the sound goes out, just type in sound, and it'll normally restore a couple seconds. Okay, so some of you guys typing some funny comments here. Let's get started here. So the first thing I want to cover is it's very important to know the rules, because this is what I find that happens to traders. Now, I love it when you guys send me some of your trades, especially your oops trades, because you know, I understand your frustration, and a lot of you send me these emails saying, I'm frustrated, I can't trade, you know, I don't know what's going on, blah blah blah. And the bottom line is you're not sticking to the rules. You have to know the rules for your strategy, and then you have to know what your trading plan is going to be with the strategy. How many trades are you going to do? Which markets are you going to do? Are the markets that you've chosen suited to your personality? As I've just clarified, if you're a hesitant trader, it's no use trading in crude oil. If you're scared of losing money or risk, no use trading in gold, because you're going to have a lot of heat in that market sometimes. So you know, you need to figure out what it is you're comfortable with, and like I said, back test it and know your rules. Now, here's a trader who's also sent me in a snapshot, and she's also at that frustrated point, which I'm trying to help right now. But I want to use these charts because it's a classic example of an oops trade. She sent me here, and what do you think is the oops on this particular entry? At this pink bar here is where she entered, and she closed it out at a loss. What do you think the oops is there? Try to magnify this a little bit so you can, oops, ooh, a little too much. Can you guys hear me? You guys can hear me. Should be going long, not short. Right? When short, long, not short. Okay, right into the 13. Right. So if it's obvious right now, she's trying to do what's called a counter trend. Trying to do a counter trend. And one of the first rules of the counter trend, I'm sorry, I'm just trying to move a couple things here. The first rule of a counter trend, or one of the main rules I should say, is 5 or more ticks of divergence between the entry and the 13 EMA. You must make sure that your point of entry, that whenever you're doing a counter trend or a gap trade, that you never enter on the 13 EMA. Never, ever, ever, ever on the 13 EMA. Okay, so we're going to cover that a little bit more. So I just want to demonstrate that your frustration is that you're simply not following the rules. That's all you need to do, is when you're not getting it right, you need to go back. I don't have a green magic pill to give you and fix you. You need to go back and revisit the rules and say, okay, what is it that I'm missing? And you need to look at your chart like this and go, okay, what did I miss here? Oh, I see. I shouldn't. Okay, so from now on, I'm not going to enter on the 13, right? So here's another one. I'm just going to be real quick with this because I got other things I want to get into. I just want to show you that the bottom line of your frustration, if you're frustrated and things are not working, the bottom line is you're not following the rules. Here's another one. Going short. So what do you think the problem is with this one? Going short, you have to turn around and close it. Green HMA, yes, the HMA is green, and she's trying to go red. So understand that this candle was probably red, and candles, as I always say, are liars. You know, well, let's just say that they're short-lived. Okay, that 1 minute they're red, the next minute they're green. Above the HMA, yes. Too close to the 13? Well, here's the rule for clear trades. For entry, when it comes to clear trades, or trend trade, what is the basic principle for entry? And I can't even tell you how many people, when they send me and they go, is this a good entry? Is this and they do not follow this very simple rule. Enter on the touching candle or the very next bar. Touching candle or the very next bars. So we're going to talk about that. So where do you think, if she was going to take some price action, regardless of this HMA, if she was going to take some price action on the so-called trend trade, where would the point of entry be? It would be this candle or the very next bar. Can you see that she's 4 candles into the move? Okay, 4 candles into the move is just simply too late. So if you're going to do a trend trade, you only really, if you want consistency, you only really have these 2 candles as your point of entry. Now it's very easy to see after the fact that this move is like 7 candles, this move is 4 candles, and the reason why I say the 2 bars, regardless of whether you have 7 candles in a move or 4 candles or 5 candles. See, this one had 3 candles. The point is, you never know how many candles you're going to get on a typical trend. Some trends are a little flatter than others. Sometimes it's a one-directional day. You never know how many candles you're going to get. Sometimes the candles are really long, so they give you more price action, like this one. Sometimes they're really short. So to be safe, if you're looking for a business model, a business plan to your trend trading, you have to decide, I'm going to enter within these 2 candles. This is the safest area, so that if you end up with only a 3 candle move, you're likely to still get filled. That's the idea. You're looking for consistency. That's what we're looking for. We're looking for a self-organizing pattern that we can systemize and make it a business model. And you have to approach technicals with this state of mind. You can't say to yourself, well, I thought the market was coming down and the 15-minute was saying it was down and the yada yada was saying it was down and the thing was... It doesn't matter what you think the market was doing or what it appeared to do. If you do not stay within the criteria for the rules of the strategy, the market is going to surprise you. Just when you think it should have done what it was supposed to do, it's going to do the opposite. That's the nature of the market today. Okay, it's a for-profit business. It's there to go for people's stops. They have all kinds of gimmicks to go for people's stops. So you cannot trade based on forecasting. Forecasting is going to get you in trouble because you're going to have a biased viewpoint in approaching the market. You have to trade a set of rules and follow it as a self-organizing pattern to become a consistent trader. What is the black line? Oh, these are just her 3 stows. Don't worry about this. We'll come to the basic chart. Now, when getting started, okay, I'm going to move this up. The purpose of this class today is to redefine what your set of rules are, because if you're dumbfounded as to why you're losing, I'm telling you right now, you're breaking a rule and you need to go fix it. You need to fix it. I don't want you to just keep trading and trading price action. You know, who cares about price action? You're just a dilly-dally. You're a dilettante. Stop being a dilettante in chasing price action. I want you to focus and go and learn the rules. I want you to go, you know, remember when you're in school and you failed the test? You had to hit the books and go relearn it. I want you to go relearn the rules for the strategy and retest it. We backtest it on the replay. Okay? So stop dilly-dallying and chasing price action. Endless hours on the simulator and so on and so on. Just chasing price action. So here we go. Let's talk about the strategies. So everybody's on the same page. I tend to use, in getting started, I'm going to recommend for a template, start with my Mel Basic chart, and then you're going to add the HMA color change. Now the HMA color change, you just simply go to indicators in the top box. Everything in the top box is where you can add things, and everything in the bottom box is what's on your chart. Now if you're not familiar with Ninja, they do have free classes on the Ninja website, and we do have videos in the FAQ for you to watch that introduce you to Ninja. Now there's your HMA color change. Make sure you choose the one that's color changed, not just the regular HMA, so that it changes color to help you see the change in price action, and you simply click new and apply. Now as you can see here, this green line changing from green to red is my HMA color change. Now I've created a simple chart for the purpose of demonstrating the rules for you. Somebody says, dang, ladies found me out. I'm telling you right now, I've been coaching for, goodness, it feels like forever, but for years, and you know, and your questions are not new. I get the same questions over and over and over, and most of the time, I'll tell you right now, a lot of your problems can be avoided if you just revisit the basics. So the first thing we're going to talk about is when, as I always say, there's only 3 positions. I'll go over the short list in just a minute. There's only 3 positions in the market, and this is true for stocks, options, forex, futures. Doesn't matter. It doesn't matter what market you trade. So the good news is, once you've learned shadow traders, you can pretty much apply it to any market, because the rules that we teach you in shadow traders are universal. They are the market's rules. Okay, they're almost like insider rules that nobody else is really talking about, and that's the nice thing about shadow traders, is that we give away that real insider's view of the market. Now the first thing you're going to learn is that there's only 3 positions. One is called a trend, and a trend is simply when the price is clear of the moving averages. So now you can see here, I've taken some of the moving averages off. I only have 3 for this demonstration. I have the 200, and I have the black one, which is the 20, and the green one, which is the 13. The second strategy is our counter trend or closing the gap. We call it the gap close. And the gap we're referring to is when the price action returns after it's been trending to the 13 EMA. So this divergence here, I can highlight it here, that's created from the trending is what we call the gap. As you can see here is a nice one. Price action is clear of the moving averages, it's trending up, and when it returns, it's now closing that divergence. We call that the gap trade. So based on the calculation of the mathematics with the 13 EMA, which represents 13 candles of X evolution, and it's an exponential moving average, and so it's always moving real time. It's a faster moving average compared to the other ones. It uses this pattern. This looks like waves, right? And it's very important to understand these waves and how they work, because this is the secret to timing. The third position in the market is when you see these candles are consolidating. They're really going sideways. We call that a flat market or in a fist. And when you see the price action is sandwiched like this between two moving averages or three moving averages, we call that a sandwich or a fist. This is a very bad time to trade. You always want to have a real finite specific point of entry and a specific point of exit. So let me just I'm just going to pick the best examples here that I want to demonstrate, just to make it easier for this basic concept that I want to show you first. Okay, let's just go to this section here. Yeah, I think this is a good section to explain. Now, this is a Forex market. The euro is the same as the euro currency. Okay, this is just the Forex side, which means the brokers, it's filled by brokers. So the nice thing about the Forex market is that you can trade it and you won't have any filling issues. You know, futures, once you get up into too many contracts, you can have filling issues, especially depending on the volatility. Whereas on the Forex world, the brokers fill your orders, and so there's no, you can dump 500 contracts in the Forex market, and you won't have a problem. Sure, Ray. Define too many contracts when dealing futures. 50 contracts too much? Well, it depends. You know, it depends which market, because some markets are more lightly traded than others. Like NG is a lighter market than you know, crude oil or you know, the euro. So it just depends which market you're trading. You're going to have to test it. You know, you're going to put 30 contracts or 50 contracts on, and also depending on the time you're trading. So this, you know, something you're going to have to figure out, but I don't think most of you are there yet. Now, let's take a look at, yeah, so filling issues is number of contracts. If you have 50 contracts and the market's too light, it can only fill 30. It'll leave the other 20 on the table. The first thing I want to cover with regards to the trend trade and counter trend trade is there's two terminologies that we're going to learn first. Now, the trend trade is basically starting, clearing the moving averages, starting, like I said, with the touching candle or the very next bar. So every time these candles touch on that 13, you have an entry. Now, it has to be the right color matching the direction of the 13. So a touching candle that's red does not qualify as a point of entry. It has to be, that just shows that the gap is closed, the previous strategy is closed. It has to be a green touching candle or the very next bar as a point of entry. Now, there are times where it didn't quite touch, but as close to as possible is also acceptable. So I always pick the candle that's nearest to the 13. Here's another example. As you can see, touching candle or the very next bar. These are your points of entries for your clear trade. So for your clear trade, the first rule is you're going to look for touching candle or the very next bar. The next rule is you want to make sure that your 13 EMA has enough trajectory. And the way we look for that is there's a degrees box in the top right corner here, and you want to be above 15 degrees. Now, some people qualify that even further by saying, well, I'll only pick the ones that are 25 degrees or more. Some even go as high as 75. They only jump in the ones that are 75 degrees. So you can play with the degrees, but the basic rule is 15 degrees or more. But how do you know it will go up and not fizzle out? Well, we'll get to that in just a second. You're 3 steps ahead. Okay? You have to understand that the basic rule you know, can you hear me now? Are we back? Are we back? Are we back? Yes, we're back. Okay. So the basic rule for trending is that we're basing it on the mathematics of the moving averages, and which comes to the next point. In the rules, you must have 3 or more moving averages back in the direction of the 13 EMA. So the 13 EMA must be included in one of the 3, and it can be any color as long as you have 3 or more moving averages. So to answer your question, how do you know it's not going to fizzle out? Chances are, if you have 3 or more moving averages back in the direction and you're catching the first 2 bars, things are going to go in that direction. It's going to go from A to D as opposed to A to B, right? And that's the idea here with trending. The only time things are going to fizzle out if you go on a touching candle is if you're in a stuck on a barrier like the 200 moving average, as you can see here. So a barrier like a pivot, a fractal, or another moving average, then the price action is not clear, is it? It has to be clear of major barriers. So if it's stuck on a major barrier, then it's going to fizzle. And the other condition for it fizzling is if the 13 is flat. Those are the only 2 really conditions that it would fizzle, or it doesn't have 3 moving averages. So let me say this again. 3 conditions why a trend would fizzle. Here you can see we're trying to go up, and it fizzles. Why? Because we don't have the 3rd moving average below. There's nothing below. There's only 2. There's the 13 and the black one, and that's it. So there's nothing back in it. There isn't enough mathematics yet to go higher. Let's take another one. Here's a barrier. So the second rule is it's hitting a barrier. And the third rule is the 13 moving average is just simply too flat. As you can see here, we're not going anywhere. 13 moving average is too flat. Now, the moment the 13 takes on trajectory, we've got that 15 degrees or more, then price action will go ahead. Now, I don't have the other moving averages here to show you where we have 3 moving averages, but I just want you to basically look at how price action behaves first of all. Now, this is euro, so it moves slightly differently to the currency in terms of plotting. I'm just trying to find a better scenario for you. Okay, so the first thing you want to look for that's all there is to trend trading, really, is that we're bouncing off that 13 and you want to get in as close to the 13. Think of it as the ball leaving the bat. Now when we come to counter trending, there's two terminologies I'm going to cover. First one is called a retracement. The second one is called a reversal. So when we close the gap, you'll notice that some of the time we don't even make it to the 13. Sometimes we make it to the 13 and then we bounce on the 13 EMA and continue higher. And other times we not only do we make it to the 13, but we go through it and cause the 13 EMA to cross that 20. So what's the difference between the gap closes? Well, it's very simple. If we think it's not going to make it, or it's going to go to the 13 and bounce higher, because we're still in the middle of the party, so to speak, it's still strong momentum, lots of price action still going in that direction, then we call this a retracement. This is a short-lived move, and this is our basic, very basic scalping gap trade. Now, this over here, the reversal, is basically the market trying to change direction. So this is our major trend change. So now we're changing direction from a bullish trend to a bearish trend. Now notice that not all first attempts succeed. So just because we reverse it doesn't mean that it's going to go all the way down to the 200 on the first try. It tried it and then, oops, do we have some sound problems? Just want to make sure. Are you guys following me here? You guys can hear me, right? So yes, okay. So it tried it and then it continued higher because the momentum was still there. Now, this is the thing you got to be careful with when it comes to currencies. It doesn't always do it on the first try on trend changes because there's so much push for trending. Currencies seem to trend and stair step a lot longer than the energies. Things like, you know, or markets like gold and crude oil, they don't tend to trend as much. They tend to go back and forth and swing nicely, which will give you better reversals and counter trends. So notice that it eventually reversed and continued lower to change the direction from a bearish market, from a bullish market to a bearish market. So you want to watch your timing on this particular move. But right now, I just want you to understand that a retracement is a scalper's trade and a reversal is the change of direction, which we call the perfect trade. Now, the basic rule for a scalping trade is simply this. We're going to look for the circle with a dot, which appears when we're about to confirm a high and get an asterisk. It's telling you that a fractal is about to appear. And I don't have the fractals on this chart for the moment, so let me just pull up this one here. Can you see there's the circle with a dot? That circle with a dot, there it is. When it settles, it becomes an asterisk, and a fractal line will appear, a new fractal line. So that basically says we have a confirmed high or a confirmed low. So when the circle with the dot appears and you get a long wick, then you know that, or the tail has appeared, then you know that the market's ready to change direction. So if you notice here, these wicks, long wicks, the asterisks were circles with the dots first, and this is where you know that the market is ready to change direction. What do you do when you end up with an asterisk at the bottom of the candle and at the bottom of the candle and at the, I'm not sure what you mean. I'm not sure what you mean by your question. You can only get an asterisk at the top or the bottom. So if it's at the top, you're coming down. If it's at the bottom, you're going up. See, here's your bottom asterisk. It means that we're changing direction up. And because it's a scalper, it's a gap trade, it's a finite move. It's not a very long move. Now notice we haven't had a circle with a dot here. This market's not ready to go up. What do you do when you end up with an asterisk at the bottom and then it switches to the top? Well, if it switches, you just wait. Wait for the next bar. If you're not sure, see, like here, now it's become an asterisk. If you're not sure, then just wait for the next bar. Always understand that ideally, you know, the price action can change, the circle, the dot can change back and forth, but ideally you're looking for a specific direction. So if the market's been going up and you see the circle, the dot with the fractal coming in, then you know that you're really looking to go short. So if the circle, the dot's at the bottom, then you just wait for the shorting to start, because that's your move that you're anticipating. You're not anticipating to go up at any point, and if you are, then you're really looking for a different criteria. You're not looking for a gap trade. Candle with a long wick or tail has already appeared, and there must be 5 or more ticks divergence in entry before we hit the 13 M8. So I'm going to go with this new chart here. Now you see there's the long tail. Now watch, a circle of the dot's going to appear to change direction here. But I want to quickly show you this. Notice here, if you don't see that there's 5 or more ticks, especially on these ones here, for your entry, then you don't have a gap trade. And this is where a lot of you make the mistake, because you enter right on the 13, and there isn't 5 or more ticks. You got to jump in at your point of entry and guarantee that you're going to get 3 ticks inside of a 5 or 6 tick move. That's the idea for scalping. And you'll notice that the point of entry, the Linreg 4, that's the only time I use the Linreg 4, which is the brown Linreg, makes a very sharp V. Very sharp V. So it will give you a nice Mount Everest point. Can you see that? On these gap trades. So the circle dot point, the Linreg will make a V, and then you jump in and you grab your 3 ticks inside of a 5 tick move. Now you can wait for the HMA to change color, but on some moves it's going to be too late. Like you couldn't wait here because you're too close to the 13. Maybe over here to do the reversal, if you wait for the HMA to change color from green to red, this will be a good time to do a counter trend trade. So, but if you're looking for a very tight 3 tick move, then I wouldn't wait for the HMA to change color. I would use the Linreg making a V, and you jump in and you take your 3 ticks. So let me go to real time for a second. Is there any questions about these basic rules? It cannot be any more simple than that. It's touching candle, the very next bar, degrees, 3 moving averages, and we'll get to the last point in just a minute. And then there's circle with a dot, long wick or tail, 5 or more ticks, Linreg gives you a V, and for those of you who want to use the HMA, you can. Now, these rules are actually in your members download, and it's called the 10-second document. It's in there under members download. These rules are there. It's a PDF called the 10-second. If you go look at the members download, you'll see it there. So I'm just going to move that out for a second. Use the LR4, the 9 with the HMA. Now, when I'm doing scalping, the 3 tick strategy, I use the LR4, which is the brown one. It's the faster moving one. Now what I can do, if I'm doing trend trading, I don't need the LR4. So what I like to do is I'll show you for the exercise. You can actually remove it or just make it transparent. And what this does is it allows you to see a much cleaner picture, but just observe the trend. So this brings me to my next point. A lot of you are using too many indicators for your desired trading plan. You can't observe everything in order to find the perfect market. You're not going to get the perfect market. And this is another reason that I really like to address struggling traders, is that you waste endless hours and months on end on the simulator trying to be the perfect trader trading in the perfect market, and then lo and behold, the day you try to go live, it's not such a good day in the market, and you just louse everything up, Then you get deflated and you go spend the next 6 months trying to be perfect again. Okay, stop chasing perfection. There's all kinds of gimmicks in the market. You're not going to be perfect. You're going to make some oopses, so you have to apply risk management rules, which we can get into later. So we're not chasing perfection here. We're looking for a self-organizing pattern that's going to repeat itself 90% of the time. And chances are that we're going to get it right if we follow the basic criteria. Consistency is hard to realize, yes. Don't sacrifice the good in pursuit for the perfect. Exactly. We're looking for just the chances are. You know, you can always get out of a trade. And this is the other thing when you're chasing perfection, is that you're so dumbfounded when you're in an oops trade that you become the irrational trader. Logic goes out the window, and when you end up in an oops trade, let's say you thought that this was going to be a clear trade, and you practiced your touching candle the very next bar till you're blue in the face, and you were, you know, you were so nervous that you didn't take this one, 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 and finally, when you're ready to pull the trigger, you take this one. And it turns on you because it's the end of the party. And you're so shocked that you could get it wrong that you become, all logic goes out the window, and now you're stuck. You can't get out of the trade because you're just horrified. And the faster it starts to go against you, now you're not willing to cut your losses. You become the irrational trader. This is the problem with chasing perfection. That's me, Mark said. I'm very good at getting them top or the bottom. So I'm here to tell you, look, the rules are there as guidelines. To heck with it. Go with a few touching candles. Look for 4 trades a day. Be as conservative as you can. Look for 4 trades a day. Chances are you're going to find them. Now let me help you to improve your timing in just without even talking about complex things here. I just want to see what the price action is doing right now. Oh, it's coming short here. It's yeah, let's use this section because this is a good idea. Like I said, this is the euro moves slightly different. The forex moves slightly different to the euro. 4 ticks or 6 ticks is too close, but 10 or 12 is a killer. Yes. Now, in terms of timing, let me just do this. I'm going to scrunch this chart up for a second. Actually, let me just, I'm going to reload my template first. So we have everything there so you can see what's going on. And this is where I'm going to talk about 1320 crosses. Now let me just remove the fractals for a second. Okay, good. So now you see we have 5 moving averages, and incidentally, we only use 5 moving averages on a 1-minute chart. On all other time frames, be it a 30-second or a 5-minute or a 3-minute or a 50-minute, we only use 4. We get rid of the red one because it doesn't plot correctly. So the 200 SMA is only to be used on a 1-minute chart. If you put it on the other charts, you're going to get confused. And that's very important. Why? Because the 200 SMA decides whether it's a bullish or bearish market. So I'm going to scrunch the chart up so you can see this. It's a little too tight. Okay, so a 200 SMA decides whether it's a bullish or bearish market. So as you can see here, once we're below the 200, we're a bearish market. And here you can see we're in the battleground. When we're on the 200 SMA, we're in the battleground. This is another big mistake that traders make. You trade, or let's put it this way, you try to trend on the 200. There is no trading on the 200 SMA. There's no trading. It's a no trade zone. okay? You have to wait for the price action to be clear. If the candle is touching or close to the 200 in any form, there is no entering a trade on the 200. You can trade here, you can trade to the 200, but if it's touching or within a 2-tick range of the 200, there is no entry. Do not enter because it will whipsaw on you. The 200 is like a magnet. This is the battleground for the bulls and the bears. They're fighting for the direction of the market at this point. They want it, the one wants to take it lower, the other one wants to recover and take it back up. So somebody will eventually win. Just wait patiently and you will see, here you can see the bears held on a little longer and finally the bulls took it back and they pushed it back up. So the 200 SMA is your dividing line. Do we still like to use the pivot levels? Yes, well, unfortunately in the Forex we don't have the pivots. You don't really need them in the Forex. Do we? Why does it only apply to the 1 minute, not the other time frames? Because it doesn't plot the same number. The 200 is a constant. Can you see that it's at 3201? Let me put it this way. It's at 322.26. If that's meant to be your constant moving average, that's your dividing line between the bulls and the bears, you will see if you put it on a 5-minute chart, it's not at 322.26. So then that means the dividing line's in a different place. So it doesn't plot correctly. So there's only one dividing line between the bulls and the bears, and that has to be at 322.26. That's the reason. So the next thing I want you to look at when it comes to moving averages, which is very important in terms of timing, is understanding your trend changes. And this is where the 13 and 20 crosses come in as well. I want you to notice that the market goes into what we call a fist to a fan. So notice here that within the algorithm of how price action and moving averages plot, at some point they come together, they collide together. We call this a fist. This is when you should start getting excited, because the market always from a fist bursts into a fan. So as you can see here, this looks like a Chinese fan. The moving averages go out with strong trajectory, and that's when you know you're in a one-directional zone for the most part. That's where you know the price action is really going to continue to stair-step in that direction. So you're going to watch for these fans. Now, when you start to see the market starting to change direction, again, it doesn't always change direction on the first attempt. As you can see, here it's reversing and changing direction. It continues lower and then finally tries to push a little harder and then come back up to the 200 SMA. Richard, what's changed with the Forex introduction is that the PIP, the only reason she wasn't favorable, the question was, I thought a year ago Barbara was not favorable with the Forex. The reason is that we've negotiated deals now. The PIP value is a lot less. The spread, the commission rate for the brokers, I should say, the commission rate used to be ridiculous, and now they've brought it down so they become more competitive with the futures. And the other reason is we're introducing order trading now, which is the involving futures, and also with the introduction with the Segreta Quant, it made it more accessible and allow people to have the guidance they needed to trade the Forex. So things have evolved, as we always are, and so it's become more feasible. Now the difference between the Forex versus the futures is the contract value. You know, when you trade, for instance, the currency future, you're going to make $12.50, whereas in the Forex it's $1 a pip. So if you have to trade, you know, let's say 10 contracts, you're only going to make $10. But the nice thing of, well, let's put it this way. The difference for it's fine for people who are not American. The problem coming with Americans is that they charge a slightly higher rate to Americans to trade Forex. So the margin for the Forex is usually $35 a contract. So you can understand for everybody else it works out really nicely. It's actually less than paying what you pay in futures, because futures to make $12.50 you have to put up $500, whereas in the Forex it's $1 a pip, so if you have to put up you know, 10 contracts to make in the same range, so then you're only putting up $350 versus $500 to make that same $10 that you would normally in the futures market. Now the problem with Americans is you have to put up 75. It's not a whole lot more. So in essence, to make the same amount of money you would make in futures, you have to put up more margin. So if you think about it, if you're putting up the same 10 contracts, you have to put up $750 in margin versus $500. So that was the other reason why she wasn't favorable with it. So the difference in the margin compared to the futures margin of $500 to make the same $10 versus $750 to make the same $10, and the commission, the 3 pip spread is what they used to collect. So now they've come down a little bit. So now, you know, I think it's nice to be able to have access to the Forex because you've got some really nice trends, as you can see. And so because, you know, putting up $750 versus $500 is not going to rock my world, you know. So I still think I would do it anyways, because you're giving yourself access to more markets to trade. Because sometimes, you know, futures, you have good and bad days. You're limited in some capacities. Okay, so moving on. So the important thing to understand is the relationship of the moving averages to each other, and what are they telling you? When they're in a cluster, this is a no trade zone. There is no trending in when the moving averages are in cluster. The only strategy that you can trade when the moving averages are clustered is the gap trades. So all you can do is wait for these gap trades to the 13 EMA. Let me spread this out a little bit more so you can see the candles better. Okay. The minute you start to trend trade, by the time you see that we're clear, you're touching candle, most of you will be entering on this bar and you won't get filled. That's the problem with doing the trend trade strategy. Most of the time you'll be entering somewhere up here and you won't get filled. So instead, when the moving averages are clustered, there is no trending. The only time you have trending is when you see the moving averages are starting to diverge and take on trajectory. That's when you know that the candles are going to give you enough of a direction to be able to get your price action filled. Is that clear? This is another mistake that traders make. Only gap trading when the moving averages are clustered. I'll take up some more of your questions in just a second. Now, the next rule to learn in timing is on every trend trade, okay, on every trend, I should say, there's always 2 really good opportunities for entry. So there's what I call the beginning and the middle party. So here you can see, and the first entry usually starts with a 13 and 20 cross. The second entry is here in the middle. Now in the futures, you'll see that it'll stair step up a 3rd time, sometimes a 3rd time before it starts to change direction. But in the Forex side, you'll see that it gives you these very nice swings. So I would take the first one or the middle. That's where I would normally trade. So you always get, and this is true for the currencies in the future side as well, the first two moves are the best to trade. When you start getting into move number 3 and number 4, you start getting into problems. Let me show you over here. You see, when you start to get into move number 3 and number 4, here's the cross of the 13 moving average. See how it's crossing here? There's the first move. There's the second move. Now we're in move number 3 and number 4. You know, this is a one directional. You start to run into some problems. And you start to get into late, especially when you reach the top of the trend and you start to jump into these. This is where you start to have problems, where the market's getting ready to reverse. Now, how do you know that the market is ready to start reversing and you're looking to do your 13 and 20 crosses in the reverse? Well, the answer to it is you have to check the higher time frame, the next higher time frame, which I use my 3-minute chart to see if it's ready to start closing the gap. When it starts closing the gap, then you know that your market is, your 1 minute is ready to start reversing, because the rule is gap trades on the higher time frame cause a cross on a lower time frame. So this gap trade at 1920 is a reversal, here it is, on a 1 minute chart. Nice gap trade, nice cross. So if you're looking for good 13 and 20 crosses, at the very least, you should have a 1 minute and a 3-minute up. And I always watch to see if the candles are south of the HMA. They must be south of that HMA before I even consider that it's going to close the gap. Now, if I think it's going to be a tight gap like this, I'm not interested in trading at a reversal. Or if I think it's going to be a short-lived retracement, I'm looking for really good ones, and even possibly when the 3-minute looks like it's ready to reverse. Do you have to have a different broker, a Forex broker, to get a Forex chart? No, you can get Forex right now on your Ninja. It's all there inside your Ninja. So you should never do a trade unless you have a 13 and 20 cross. That is correct. That's the other thing about 13 and 20 crosses. The basic rule for 13 and 20 crosses is this. If you're going to just follow the green line crossing the black line, there's two things that I always follow. I do not enter the trade until the 13 has crossed. Because for this example here, if you were right side the edge, let's say you're right side of the edge, this looks like it's bouncing. How do you know, how could you know that this 13 is, this market is going to go up all the way through? Right now, you have to always follow the position of the 13 in relation to the 20. If the 13 is below the 20, it is a bearish market. If the 13 is below the 20, you have to treat it as a bearish market. So going long means you're going into resistance. You cannot know for sure that it's going to continue. And what happens is when you don't obey resistance and support rules, you get caught. It doesn't go anywhere. Now, the only time you can know is when you see the 1320 cross. So the rule is this: it doesn't cross till it crosses. It's simple. There's no anticipation here. Can you hear me now? Can you hear? Are we back? Are we back? Can you hear me now? Yes, we're back. Okay. So 13 and 20 crosses as a strategy. The rule is this: you have to wait for the cross, and you enter the touching candle or the very next bar from the point of the cross. This is the start of the trend. The start of the trend does not occur until the 13 and 20 crosses. So all trends are traded between the 13 and 20 crosses. So I call these mini trends inside of a big trend. So between this cross and this cross, we are trading a bullish trend. And our entry is from the point of cross, not before. Before the cross, we are in a different strategy. Good, Rico says, thanks, that really helps me understand. Before the cross, we are in a different strategy. We are in a counter trend. So let me clarify that, because this is a huge confusion for people. Trend, counter trend, right? Trend, you go with the 13 EMA. Counter trend, you go towards the 13 EMA. Very simple. It's all you need to know. So here you're going towards the 13 EMA. You're not trading on the 13 EMA. You're trading towards the 13 EMA. So every time the price action is going towards the 13 EMA, you're on a counter trend strategy. The trend does not start until the cross happen and the price is going away from the 13 EMA. It's bouncing away. That's when the trend starts. That's the official start. So you cannot start a trend trade if the price action is going towards the 13 EMA. Is that clear? Because then you have to say to yourself, I am in a counter trend strategy. Do I have the criteria, the rules to meet that entry point? And if I was looking at this trade per the rules, does this make up a good counter trend? What's wrong with this counter trend strategy right now? What's wrong with that strategy? Who can tell me? No 5 ticks. Exactly. Too close to 13. Exactly. So do you have a strategy to trade? No. You do not have a trade unless it meets the criteria. You have to learn to disqualify green and red candles in order to choose the good ones. Somebody says, if the 3 and the 5 minute are not crossed, but the 1 minute is crossing, do you trade the cross? Yes, you trade the cross if the 1 minute is, if you're trading off a 1 minute chart. Now you can trade a 3 minute cross. It's just going to happen at a different time interval. Here's a 3 minute. You can trade the same rule, same strategy. Here's a 3 minute 1320 cross, touching candle. Doesn't that look like a very nice clear trade? How about the very next move? And what's nice about what I actually like about the Forex is you see the two moves really clearly. Okay, you see your 2 moves really clearly. Now this is a sneaky one. Let's take a look at this one. How about this one? Do we take this trade? Is that a trend trade? Is that a trend trade? Okay, getting some no's. No's. Good. So is this an entry? And you'll get this. This is such a hypnotizing candle. This will suck you in when you least expect it. How many people have jumped in on this candle, gotten carried away, or caught the candle just, lots of people, right? Many times. This is where you have to say to yourself, it doesn't cross until it crosses. So if you don't have a trend trade strategy, what strategy do you have as your choice, if you don't have a trend trade strategy, if it hasn't crossed, what is left? The gap. That's all you got. You've only got these two things. This is how price action behaves. So per the gap trade criteria, does this entry meet the criteria? What's wrong with this entry? It's on the 13. The gap is already closed. Once we hit the 13, the gap has closed. You don't have an entry. No 5 ticks. Okay? So this is not an entry. This is an HFT. Okay? We don't care about green and red candles. What we care about, this is where you really got to train your brain not to be hypnotized by the market. And the only way you can do that is to know your rules inside and out. These are the rules you must know. You must know what 5 ticks means. You must know what the touching candle, the very next bar means. You must know what 3 moving averages back in your direction. You must know what a cross of the 13 means. You must know what trading on the 200 means. You must know these things like the back of your hand. So you don't even have to think about it. You shouldn't be thinking here. You should say, I got nothing to trade. That's what you should be saying. I got nothing to trade right now. I have to wait for the 13 to tell me what my next move is. Is the 13 going to cross, or is the 13 going to come back down? It could do either. The only trade you have is if you entered here. Is that clear? So as you can see, they just fizzled out. Now the 13 is crossed. You have a touching candle, the very next bar. Now you have a trend trade. Trend trades occur after the 13 has crossed. From the point of cross, that's where trend trades occur. Prior to that, it's a gap trade. Now where it gets really fuzzy, let's go back to the 1 minute chart. Where the gray area comes in is when we start talking about reversals. So let's quickly talk about reversals, and then we'll get to some interesting stuff. I just want to clarify these things. I'm going to find some good examples for you. Let's quickly talk about reversals. First, you have to understand what a gap trade is and what a clear trade is. Then we have to talk about reversals. What a nice juicy one. Okay, this is a good one. Okay. Sometimes reversals go really smoothly. They kind of go, you know, they just cross and off they go. And that only happens usually when the 3 minute is reversing as well. When a higher time frame is all synced up, when the 5 minute and the 3 minute is all in sync and they're all ready to reverse at the same time, then you'll see it'll go really smoothly. However, the first attempts before the higher time frames get involved, especially after a big trend, don't always go so smoothly. So this is the problem with entering on the 13. Is you enter here anticipating a reversal, and then you get the bounce off resistance. That always happens because it's a counter trend. The 13 has not crossed, and that bounce off resistance can cause a lot of stress. Some markets it's a small bounce, other markets it's a big bar like gold, and sometimes it's a little bounce, and sometimes it's a big one. Let's take a look at this one. Here we go. We're trying to reverse. We're trying to reverse, and let's say you entered on this candle, anticipating the reversal. MACD's going to cross. The stows are at the bottom. You say, off we go. We're going to reverse, and voila, you just got stopped out of the market. And then what happened? Lo and behold, it did continue. Very frustrating. So what's the rule for reversals? How do we fix this problem? How do we fix this problem? What about a sandwich? The sandwich you've only got counter trends. That's all you got. Who can tell me, how do we fix this problem? MACD, higher time frame, check in the higher time frame, wait, look at the higher time frame, confirm the higher time frame, look at the higher time frame, HMA change, 3 or more moving averages. Well, let's look at 3 or more. See, these, okay, so these are some very good answers you're giving here. Not all of them are very important. Some of them are just good important points to look at. But let me tell you, there's 2 things here. Notice that on these reversals we're looking at, we're going into the other moving averages. So we're on a counter trend versus a trend. Let's look at a reversal that's on a trend. See, here we got the moving averages on top. We've got the 200 on top. So we've got 3 moving averages back in the direction. So notice it's a little bit smoother. It's a little bit smoother. Do you see that? Not as much heat. Here's one on the counter trend. Again, just when we think it's about to start crossing, voila, you always get these contrarian candles because the heat's not over, and then it crosses. Okay, and then you go on the trend, and what do you see? It's a little bit smoother. So the first thing you can say to yourself is, if I choose reversals that are on the trend, going on the trend, it's going to be a little bit smoother versus on the counter trend. Now, on the counter trend simply means how many moving averages you have back in the direction. So again, here we are on the trend. That means we're it's about to cross the other moving averages, and usually there's a third one on top somewhere. Over here, can you see that we're trying to change the direction and we're going into the moving averages, so they're all resistance. So here we're going with the trend, here we're going into the trend. We're trying to change the direction, and we haven't changed the direction until the 13 crosses the other moving averages. See, here they're crossing those moving averages, so we're on the trend. Here the 13 is nowhere near crossing. Can you see that? The 13 is almost miles away from these other moving averages in terms of price action. So what happens when the 13 is miles away? Look, we look like we're going to go, we don't go, we look like we're going to go, we don't go, and finally we go when we get a little closer to the other moving averages. So that's the first thing you need to disqualify whether your reversal is something you should really be playing with or not. If you want less stress, then choose ones that go with the moving averages versus the other ones. So for those people who like to trade 13 and 20 crosses, I'm going to tell you, choose the 13 and 20 crosses that have at least 3 or more moving averages back in it. And if you just looking for 4 in the morning, chances are you have a very nice time. Look at this one. Very smooth. Versus fizzle. Very easy when you start to look at just the moving averages. Above or below the 14 HMA is good, yes. Now the other rule that I like to follow when it comes to reversals is the involvement of a higher time frame. Now let me see if I can clarify this for you. Let me find a nice smooth one on the counter trend. Okay, well this one wasn't too bad, even though it's kind of, let me look at 10 o'clock here. Yeah. So what I do when I'm looking for 940, you can trade very comfortably just a 3-minute and a 1-minute chart. Now if you want to look for reversals that are going to go very nicely or have longevity to them, I try to look for when the 3-minute is giving you a really nice gap trade, and I look for the candles to be above the HMA or below the HMA. So I won't enter here where the green candles are still going into the HMA. Can you see the HMA is red, the candles are below, and it hasn't crossed the HMA yet. Here we cross the HMA, the Linregs are crossed if you want to use the Linregs as well. Notice here the Linreg 9 was coming down, here the Linreg 9 has changed direction. So here you can see that we change direction, we're above the HMA, and when that occurs, you'll get a nice cross. So as you can see here on this retracement, we still got a nice cross on the 1-minute chart. Now, if I think the 3-minute is going to reverse, and how would I know if the 3-minute is going to reverse versus retrace? Who can tell me the answer? How would I know if the 3-minute is likely to reverse versus retrace? Here it's the 1320 crosses versus it's just going to hit the 13. This is an important point because I need to know this. Why do I need to know this? Because I want to know how long my reversal is going to last. Check the higher time frame, check the 5-minute chart. So you can go up in time. We pull up our 5-minute chart here. Let's pull this across a little bit. So all those people who said 5-minute chart, you get a cookie. Yeah, I've been stingy on my cookies today. Here we go. Let's take a look at the 5-minute chart. Here you can see at 10:30, the 5-minute. Notice here on this retracement, the 5-minute was still didn't really clear the HMA. Notice here the HMA has changed color. So when the 5-minute HMA changes color, along with the 3-minute is also above the HMA, you're likely to get a very strong continued reversal on the 3-minute chart. Do you see that the earlier one, the 5-minute didn't change color at all? Just the 3-minute did, but it was a very short-lived move. It still gave you a nice reversal. So this brings me to my main point, is that you have to decide when you're trading a strategy what you're going to focus on in terms of timing. And the way I describe timing is that the rules apply to everything. They apply to the 1-minute, they apply to the 3-minute, they apply to a 5-minute, but they do it at different intervals. And so you can get a gap trade on a 1-minute, you can get a gap trade on a 3-minute. You can get a reversal on a 3-minute. You can get a reversal on a 5-minute. And they're all tradable at different time intervals. So think of it as short-term, medium-term, and long-term. So if we were to say our 1-minute was short, our 3 was medium, and our 5 was a long-term viewpoint of the market, you then have to decide, you still have entries based on the short term. You still have a small scalping gap trade to be traded. But if you see that your medium term or your long term is not involved, then you know that your gap trade is going to be short-lived. Don't get in late and don't expect more out of the move. But the minute you see that your medium term is now involved, expect a little more. You now you not only have a gap trade, but you now have a cross, a little reversal. Now when you see the 5-minute HMA changes color, now expect a little more. Not only do you see a cross, but you also see a continued change of directions. So go straight to the 200. So what you're going to be looking for are the different timings of the different charts, and they're all tradable. Or you could decide, I'm only going to trade when the 5-minute HMA changes color, so I'm only going to trade that reversal. I'm not going to trade the other ones. So you can further qualify which crosses you're going to take. Are you going to take the cross where it's just going to be the 3-minute gap trades and ignore the 5-minute? You can do that very successfully. When the 3-minute gives you a gap trade, you're going to get a cross. And let's say you only went for 5 ticks, or 3 ticks. Regardless, you could do those crosses all day long when the 3-minute gives you a gap trade. When the 5-minute HMA changes color, then you could decide to do that and go for a 10-tick move every time the 5-minute HMA changes color on a gap trade. So there's different things that you can link up to decide when and where you're going to make your move. Are there any questions about that? Is anybody confused on that point? Because that's a very important point. So a lot of times when you guys are hacking on your 1-minute chart, I think it's better that you have 2 time frames up, a 3 and a 1 or a 5 and a 1, and decide what self-organizing pattern are you going to choose. Are you going to do that 5-minute HMA versus in sync with the 1-minute cross, or are you going to do the 3-minute with the 1-minute? Which one are you going to do? This is very, very important. Anybody has a question about what I just said? Do I ever use the STEMA gap fill signal, maybe on the 3-minute? You can use it. The thing about arrows is they're never 100%, so I don't like to rely on them. I prefer to look at the trend lines. Does the 5-minute HMA color change work well for the currencies, or is it better with a 3-minute HMA? You can use the 5-minute HMA. It does work because it's just showing you different timing. But I like to get in a little earlier with the 3-minute. I like to get in with a little bit earlier with the 3-minute. The 3-minute's going to give you more opportunity. The 5-minute's going to give you less opportunity. So if you let's just look at this time frame. Basically here, if we just look at the last 2 moves, here's the 5-minute HMA change in color at 9:30, and here's the next one at 10:30. So you're basically going to get a 1 every hour, whereas the 3-minute, you got one here at 9:45, and you got one here at 10:15. So you could get a little bit more opportunity. They're just going to give you different timings. I'm wondering how long it would take to get the 2 time frame use coordinated. Well, it shouldn't be a problem, If you have a hard time looking at 2 charts, then go to the FAQ section. I have these combo videos where you can combine your information you can combine a 3-minute onto a 1-minute chart. And then you can see the things all in one chart. You can play with combining the 2 HMAs on one chart if you like. Do you ever use range charts? No, I don't like to use range charts. I'll tell you why I don't like to use range charts. Because it's based on ticks, not time, and the market the true market, which is the 1-minute view of the market, the trend changes occur on time, not ticks. And so what happens is the cross is not always true on a range chart. And so I prefer to see when the cross is really, really happening. Now, somebody asked me earlier, what about fists? What do you do when it's fists? And again, when it comes to fists, you can't actually trade the cross pattern. You can't trade the cross pattern. What you need to do is you need to trade the gap trade pattern. You can, what's nice about this is you'll notice that you get these big swings. Do you see these big swings? That's when the moving average is closing. So you really need to follow the best thing to do for this is to follow the HMA color change. That should be your strategy. Or the Linray cross in the HMA. See how it changes color? You should be entering here and grabbing your ticks before you get to the 13, or riding it through the cross if you think it, because you see, sometimes you don't know if it's going to cross. Look at this. You don't know if it's going to cross. What about this one? Look at this one. Didn't cross. Talk about a fake out here. That's what happens when you're on the 200 SMA and the moving average is close. There is no trend. There's nothing to trade. The only thing you've got is waiting for this divergence, and all you're doing is you're trading this gap trade. And I would just go for 3 to 5 ticks because they're usually nice gaps there. That's the only strategy you have for FIS. There's no other strategy to trade here. How could you tell the 830 move wasn't a clear trade start? How could you tell the 830 move wasn't a clear trade start? Well, you see, the thing is you don't know. You don't know, and it's all after the fact. It's all hindsight is 2020. And here's the thing that I have to remind you, traders, which is the statement I made at the beginning of the evening, is we're trading self-organizing patterns that repeat themselves. And just because you have a whole lot of green, at the point of entry, if it didn't meet the criteria, you have to rule it out. It is not a self-organizing pattern that you can trade as a business model. You've got to have a business mindset to your trading. Forget about green and red stuff. Forget about it. There's so much price action. You're lucky if you can grab 10% of it. And you know what? You should be grateful for that. How many jobs can you click your finger and take 10% profit a day? The fact that you even expect more is going to make yourself at risk. You are putting yourself at risk. I have to drive this into you because this is the dividing line between a successful trader and a non-successful trader. The truth is, you don't know that the price action is going to shoot up there. And because you don't know, you can't bet on it. It's that simple. But what you can see is the divergence after the fact. Now you can trade the divergence. That you can bet on. Jeff says, our fat heads. I have to put things in the right perspective. I'm trying to get you guys to think like a professional and stop thinking like a technical. I need you to stop being engineers for a moment. Okay? You're over-engineering the technicals. Trading is a business. The CME is a business. And so they're there to take your money. They have these gimmicks to take your money. So I want you to start thinking as a professional trader. This is a business. And you can only be in business if you follow business rules, if you follow sound money management rules, if you follow sound risk rules, and you follow qualified strategies, a sound business model. Then you have a business. Beyond that, you have nothing. There's no guarantee. And this is the dividing line between a struggling trader and a professional trader. The one trader just sees everything as technicals and rules and thinks that just because I have something, it's supposed to do. No, there is no supposed to do. You know, everything is a probability. We bet on the probability factor based on a certain criteria. And the criteria is a self-organizing pattern that repeats itself. So if you don't have the criteria, all you have is noise. You can't bet on noise. Okay, it's too much risk. So if it's too risky, then you shouldn't be trading it. So you can bet on this divergence. When that HMA changes color, you can bet on that divergence coming back down, because now you got the asterisk, you got the long wick, you got a criteria that's tradable. That's all you got in the fist. So when it comes to trend, this is what you got with a trend. Now you've got trajectory of the moving averages. Now you have a trend. So when the moving averages are starting to take on trajectory and the price is now clearing the moving averages and clear all the moving averages, now you have a trend. Until that point, you have nothing. Is that clear? That was the lesson I needed. Thanks. Are you trading the Linray Crossing HMA on the 1 minute or waiting for the HMA to change on the 3 minute? Either or, whatever tickles your fancy, whatever floats your boat. Remember, at the end of the day, what have I shown you so far? I'm just highlighting the same basic rules I've covered before, but what I want to emphasize tonight is some of the confusions that people haven't quite clarified, and also, you know, the right approach to this. But at the same token, whether you use a 3-minute chart HMA, whether you use a Linray crossing the HMA on the 1 minute, whether you wait for the 5-minute HMA to change color, please understand that at the end of the day, you're trading the same criteria. We're just giving you options for you to choose. We're giving you a smorgasbord. We say if you like the HMA on the 5, use the HMA. If you like the Linray crossing because it's nicer for you to see, use that. If you like the 3-minute gap trade because that you feel comfortable with that, use that. We're giving you options, but they're still the same. It all falls into this criteria. All the above. Are the rules posted on the website? Yes, in the members download section under the 10-second. You will see these rules posted there. It looks slightly different. I just did abbreviated version, but it is there. What is the, and also go watch all the videos that say clear trade and all the videos that say gap trade. You need to do some of those videos in the self-paced course. What is the best method to identify the trend is starting from a fist? Always the higher time frame. That's a good question. I get that periodically. So let's take a look at that. Now, here is where the Segredo is really going to help you. You know, there's also another fuzzy area, and that's coming out of the fist, because you get things like this. Can you see here our moving averages are clustered, and look here, we've got a cross, and it looked like it was ready to go, but it didn't go, and then it goed. Then it went. This is where this are we back? Oops. So annoying with this sound thing. Okay, are we back? Yes. Okay, great. Don't worry, I wasn't talking. So this is where the Segredo can help you, because on the second square, you're likely to get a number 1 on the 1 minute. On this, you're likely to get a 1 on the 1 minute. But when you use 2 time frames of a Segredo, like I'm using here, you will only get a number 1 or 2 on the second major entry. Over here, you won't get anything. You'll get Christmas. So having the Segredo is very useful to know when it finally is going to start the trend out of a fist and versus a false start. You get these false starts before the real start. And the Segredo 2 time frame, waiting for the second time frame to confirm, will do that nicely. And the 3-minute will really help you with that. But let me just show you something here. If you go to 3:30 on the 5-minute chart, okay, so here we are. Notice on the first start here at 3:25, right here, that we have the HMA hasn't changed. Can you see that? And that's what I wanted, and I'll do this next week. If you come next week, I've got a really nice exercise for you. Um, I wanted to do it tonight, but I had a problem downloading the replay. I wanted to put it on high speed. What I'd like you to do is download a day's market, and then I want you to put up a 1, 3, and 5, just with the candles and the HMAs. And I want you to notice the HMA. Notice here at 325 where we have this square, if you go to the 5-minute chart, notice that the HMA hasn't changed color. And the candles are going into the HMA. It's not in sync yet. Only here at 330, now 335, where the HMA changed color, are we ready to rock and roll. So using the HMAs can also help you to see when they're really ready to go out of a fist. And here's the other thing that I want you to notice. Do you see that we're basically, what you have to understand, what causes a fist on a 1-minute chart? Who can tell me what actually causes this fist to fan phenomenon that occurs on a 1-minute chart? Because that's the real answer to the riddle. Does anybody know? Some of the other guys in my early classes may know this answer. What causes that phenomenon, fist to fan? From a technical standpoint, not a fundamental standpoint, from a technical standpoint. Landing on the move. Oh, let me see. Oh, some of you guys are good. Turning over, changing direction. Good. So all those you said, land on the 13 or changing direction on the higher time frame, you guys get a double chocolate chip cookie. Notice that you'll see here. Let me see if I can find a better one. Let me find a real proper fist. Okay, here's a nice one. The one that just happened. Let me see. 1950. It was 20. Okay, it's a small one, but it's still. But here we go. Notice we have a little fist here into a fan, right? Can you see? We started out as a reversal, then we came with these moving averages, and we had a small little cluster. Wasn't a major one, but it was nonetheless, it was a cluster. But look here. It's between 1950 and then it broke at 2010. So let's draw a little square here. It started to merge into the fist from 1945, and it broke by 2005 it started to break. 2005. Let's look at this one over here. Here we're in a fist at 1835 to 1850. So in between the fists, what you need to look at, okay, well that's more of a sandwich, but in between the fists, okay, you get trending and reversals. So there's only 3 patterns to the algorithm. You're either trending, clear of it, you're counter trending and reversing, or you're in a fist. That's it. It's fan, reversal, fist. I want you to think of it like that. Again, fan, reversal, fist. So let me draw a circle on the reversals. Reversal, okay. And then we draw a nice little triangle on the fan. So you got fan, reversal, fist. What causes that? Remember, your 1-minute chart is just showing you what's really going on in the market up close. So if you think of the market as not as a short-term view, the 1-minute is a short-term view. The market, let's say the market is really a 15-minute chart or a 5-minute chart. It's a longer-term view. So if we were to say hypothetically that the market is not a 1-minute view, that's just looking at things up close. Now, if we look at 1950 from 1945 What do you see here per the 5-minute chart? Do you see that we were switching strategies? So we were doing a reversal, then we were doing a gap trade, and now we switch from a gap trade to a trend trade. So we actually were switching strategies, and in between we had to land on the 13, we had to finish the counter trend, and then we switched to the trend. And during those switching, can you see how the Linreg goes from one position to the other? So from a technical standpoint, the Linreg has to flip around a little bit as the candles going up and down, and they're deciding, the bulls and the bears are fighting again. They're deciding, do we want to go bullish or do we want to go bearish? And here you can see the bears won. During that decision-making process, as they're switching direction, you get the fist. So as you can see here, the 5-minute was reversing, the 1-minute reversed. The 5-minute did a counter trend, okay? It tried to do a little gap trade, but during that switching, it then goes flat. And then, so how do you know the direction of a fist? Who knows the direction from fist to fan? Here you are, real time. Here you are, right side of the edge, and you want to know which way this thing's going to break out of this tight sandwich or fist. How do you know? Wait for it, 13 EMA leading. MACD, no, MACD will fake you out, that's for sure. Watch the 13. No, 13 will fake you out too. Check the, you don't? Donna says. The asterisk? No. The answer is this. And it's got nothing to do with MACDs, it's got nothing to do with the 13, because the 13 can turn around, it can stay at that 15, come right back down. You don't know the direction of a fan to a fist. You see, because you get all these false starts. This is a false start. Look. Now the 13 is coming back down. So do you see that that 13 crossing was a false direction? Do you see that the MACD was a false direction? Your stows are not even going to help you. Now the MACD is coming back down again. Check the barriers. No, the barriers are not going to help you either, because the price is sandwiched, so it's all one big barrier. So you can't say that it's going to stop on the 50. How do you know it's not going to stop on the 200 and go back up? How do you know which direction it's going to break out? 50 crossing the 100? Not necessarily. Not in a fist. Anything is crossing anything in a fist. So you can't guarantee with the crossing of the moving averages. The only way to know is to filter the noise by checking the higher time frame. So all those who said higher time frame, you get a cookie. Be patient until you can tell. You can, but then you might be late for your entry. See, you might decide you're going to take, you can wait for the next bar to go lower, but sometimes the false start also gives you 2 bars. And then when it really, by the time it really goes, then you're too far from the 13 and you don't want to enter. The real way to know is check the higher time frame. Well, let's take a look at this. If you were looking at a 5-minute chart, what position is the 13 in relation to the 20? It's short. What color is the 13? It's dark green, so it's resistance. What are the chances of that 13 just shooting up right now? Not very strong. Now you see your HMAs changing color and your Linregs are crossing. So what direction do you think this fan is likely to go? Short. What are the odds of it going long? Look at your 5-minute MACD. Remember, your 1-minute chart is a head fake at times because it's looking at too many details. Do I look at the MACD? Do I look at the 13? What about the 50? Everything is contradictory because there's too many, it's too up close. But now you stand back a little bit, and the only way to see the bigger picture is to go to a higher time frame.
Now,
Now, your 5-minute chart, is now filtering those details out for you and giving you the bigger picture. Can you see that? So again, that's the reason why I always say to be a true trend trader, you have to have 2 time frames. You cannot trend trade on a 1-minute chart. In fact, you're probably better trading off a 3-minute chart and a 5-minute chart, just for that very reason. Is it not then better to trade with a 3 and a 5 and a 15? It is. You see, look at your 3-minute chart. Here's the same 2000 fist. Here's the fist on the 1-minute chart. Looks a little more clearer, doesn't it, on the 3-minute chart? It's very simple. We reversed. We're bouncing off the 50, but we're not going long. Who can tell me why we're not going long? Let's see if you guys have been paying attention tonight. Who can tell me why we are not going long on the 3-minute chart? Or we're not anticipating anything long yet? MACD is a fat snake. Well, the MACD is a laggy indicator, so the MACD is not always going to be there on time to tell you it could turn. Why are we not going long? 13 below. 13 does not cross the 20. Jack, you get a cookie. Everybody said the 13 is below the 20, or the 13 does not cross, you get a cookie. It doesn't cross till it crosses. It's that simple. It doesn't cross till it crosses, and it's resistance. So therefore, you wait for the HMA to change color or your Linrex to cross down, and you see that is the direction of the fan per your 1-minute chart. So it's 3-minute or 5-minute. And if your 3-minute is in a fist, like one of these, 1730, here's a nice little fist on a 3-minute chart, and you don't know the direction. How do you know? You can't trust your MACD. Your stoves are not telling you anything. It could go either way. You can check your higher time frame. Here we are at 1730, and we're at this point. You can wait for your 5-minute HMA to change color. Now it hasn't crossed, and you can check your next higher time frame, your 15-minute chart. And what do you notice about your 15-minute chart? It just completed its gap trade, and the 13 is still support. It's now crossing, and we're going from a gap trade into a trend trade. Okay, so always those switches, what you're looking for are the switches from gap to trend or trend to gap. They happen in both directions. Those switches is what causes a fist on a lower time frame. So whenever you're looking at a time frame and you're faced with a fist, let's find one on a 15-minute chart. Whenever you're faced with a fist and you want to know the direction. Oh, here's a nice one. What do you do when the 15-minute is in a fist? You go check the higher time frame. Okay, 7 o'clock at, oops. On the 3-minute chart, the 1320 cross is better signal, and audible alert could be helpful. Yeah, I don't like alerts though. Go higher. Exactly. Look at the 60-minute time frame. So here at 1900 at 7 o'clock, if we go look at the 60-minute time frame, What date was I? Where was my, oh, there's my square. Is that it? No. Sorry, I lost my position there. On the 19th. When you're 15 minutes in a fish, you go have a cup of coffee. Yeah, when you're 15 minutes in a fish, you really only, you come back or you just scalp 3 ticks on your 1 minute chart. Gap trades, it's all you got. So here you go look at your 60-minute chart on the 19th. And it's not as crystal clear on the euro as it is on the forex as it is, but basically again we're changing direction. We're changing from the down to the up. Now it is a little flatter, so if you think it's flat, then you can go check your 120-minute chart. So the same thing is you just keep going high and high until it becomes clear as the direction, and at the very least you wait for your HMA color change to confirm. So I hope that's cleared things up a little bit with regards to reversals. Now there's, let me say as my final point with regards to reversals, you've only got one place to really enter reversals that I think is going to minimize the heat for you. Well, let's put it this way, you only have 2 choices. Just go a little earlier because the market's flattened out now. See, here's a nice one that went nice and smooth. You MACDs and your stows. So you've got 2 choices. When it comes to reversals, you either enter at the cross, from the point across, and you get your price action, or if there's a nice gap trade, you enter on the gap trade like one of these, so that if you suffer a little heat, at least you're still in the profit and you trade through the cross. Those are your only 2 choices, but it is not recommended that you enter on the 13. And to minimize your heat, you want to wait for currencies. I use the 3-minute chart. You want to wait for your 3-minute chart to confirm its gap trade and the price is above the HMA. So as you can see here at 1735, the price is now, the HMA is green and the price is now above the HMA. That's what I would confirm with the 3-minute chart if you're going to trade 1-minute crosses. And if you wait for that HMA and the candle to be above the HMA, chances are you catch the really nice ones. And if we look at this one over here, 1500, you see you got a nice gap trade as well. Price is above the HMA. If you just use your 3-minute chart at the very least, and I'll tell you right now, let's say we take off, if you just do this, if you go to your ST Supras, and you on your 3-minute chart, you take off some of the colors. Let's just say for hypothetical, because you want to make a certain rule stand out, and this is a good way to fix problem traders, is when you find that you, has the sound gone out again? Is the sound good? Sound good? Okay. Let's say we take off the other moving averages, right? And because what are we trading essentially? We're trading that HMA color change on the 3-minute chart. When the candles are above, I'm using that to link up with my 1-minute chart to help me get my good crosses. And so for those people who want to trade good crosses, if you wait for that scenario, and ideally also pick the ones that go with the moving averages, chances are you'll have a much better time. Make sure that you link it up with your 3-minute chart. Now, you don't need all the extra stuff. You just want to know that it's closing the gap, price is above the HMA, HMA's changed color to green, and you should get yourself a very nice little cross trade. And that's what I would trade for 13 and 20 crosses. And you can do the same with the 5, you're just not going to get as many. See, here's a cross. This one, the HMA didn't change color. Only from this point here, the HMA changed color at 1600. So if we go to 1600, because it's a nice little price action. I may not have taken that being on the 200 there. May have ignored that. But here's another nice one at 1655. We go to 1655. Here we are. HMA change color. Very nice cross. It helps if your 20 is angled in the direction of the reversal, same angle as a 13, both positive or negative. Yeah, you can also look at the 20 if you want, if you like. So we're coming to the end now, and unfortunately I didn't really have a chance to trade tonight. I apologize by not. I really wanted to show you the euro because it's really performing well lately, and the rules are really crystal clear on that euro and NG. But you can apply these rules to any market. You can do it on gold and crude oil as well. But here's what I would encourage you to do. Learn the rules, know your rules for your basic clear trade or counter trade, and then decide to focus on 2 time frames, whether it be a 1 in a 3 or a 1 in a 5, and then keep the 15 minutes to just check in with once in a while and decide whether you're going to do a clear trade, starting with a touching candle. Make sure it's from the point of cross onwards. Decide whether you're going to do a gap trade. Make sure you have 5 or more ticks, scalping your 3-tick trade. Or decide whether you're going to do reversal, checking your 3-minute to make sure it's really going to reverse. And again, your reversal you can trade from the point across or from the point of the gap. So you can start your reversal here, you can start your reversal here. Either position is acceptable as long as you know that you're going to get your price action based on your higher time frame. Is the auto trading close? It's going to come out real soon, real soon. Don't forget about the ATM execution. Oh yes, so the other announcement I wanted to make is that for those people using the Ninja Trader ATM strategy, for those people who are paying the $60 a month, there's one thing that we found out that they never published, and that is if you, I'm just pulling up the dome here to show you, if you use an ATM strategy, you may never hit the close button. So in other words, if here I have it on none, if I put it on custom, or if I put it on a strategy, and I enter the market, and I've got my profit and my stop there, you may never hit the close button. Here's the reason why. Ninja has this agreement worked out with the broker that if you have a strategy already in place, the close button is treated as a new order. It's not a correction for the existing order. And they have some bogus rule that because a new order it's certain milliseconds faster than changing an existing order, they penalize you by taking 15 ticks. So if you're 5 ticks in profit and you hit the close button, you lose 5 plus the 10. So you lose a total of 15 ticks from your profit position. From your profit position. So if your profit position is at 20 ticks and you hit the close button, then you'll be plus 5. Yeah, it's just really that you move your green onto where the price is trading at. And the best thing to do is, I personally feel, is just use the bracket orders and don't even bother with the ATM strategies. I don't even use them anymore. But for novice traders, I like that. But remember, if you're in a panic mode, you don't want to hit that close button, you'll lose 15 ticks. So what I would do is I'm just waiting for the market to connect here. Is this new? Apparently it's been there. It's always been there, but we just didn't know about it. So here you are. Let's say if I put on a strategy 312, so I'm just going to jump in, buy at the ask. Okay, so there's my profit. There's my stop. If I hit the close button with this on, I'm going to lose 15 ticks from my profit position. So the only way to get out of this trade, because both these orders are already sitting at the CME, so if I was to hit the close button, it would cancel this order and fire a new order to close. That's how it works. So in order to change an existing order, which is what this is, you have to left click on the green, but make sure you do it in the center price column and put it onto the yellow. That's the only way to get out of this position. Or you can move your stop up. The problem with moving your stop up as opposed to the green bar is what happens is when you're in a real account, it will only let you go there, 2 ticks below the actual price. It won't let you put the stop onto the yellow where the market's trading at. It will only let you go, so you still lose 2 ticks. So either or. So the best thing to do is to just bring the green down onto the yellow to get out of the trade. That's the easiest and fastest way to do it. Is this also true for chart trader? No, this is not true for chart trader. Oh, well, it's still true if you use the ATM strategies. See, if you use the chart trader,